With us is Stephanie Link, Hightower's chief investment strategist and a CNBC contributor with some stocks to watch. Stephanie, you've got three stocks that you've got your eye on and think we should too. Let's begin with one that hasn't gotten a lot of love in recent years, IBM.
That's for sure. It's good to see you, Tyler. This is a restructuring story. So any progress they're making on the new businesses, which are really cloud and AI, blockchain, that sort of thing, that's what we're focusing on for the quarter, right? Remember, they bought Red Hat 2 years ago, and that business has been on fire. They grew 17% last quarter alone at Red Hat. So I expect the momentum to continue, but this is the focal point for sure. Now, they also spun out their infrastructure outsourcing business. Why this is important is because it's been a drag on sales by about 100 to 150 basis points. So I think that'll be good news. That's November 3rd, that official spin. And then, of course, just in general commentary about enterprise spend and the recovery. We've heard from Salesforce, we heard from Workday, we heard from Cisco, all starting to see a recovery. I expect IBM to benefit as well. It's not expensive. It's 13.5 times earnings, and you get a 4.5% dividend yield while you wait for the restructuring.
Stephanie, what did you think about what Jim Chanos just revealed on the halftime report, that he's short IBM and he's questioning their financials?
I can't speak to what he's coming out at with regards to being shorted. But I would just simply say, I think this new management team is really doing a very, very good job at focusing on what they can control. And they do have a whole new leadership division, right? And so I think it's really all about, can they shed the businesses that aren't working and the more mature businesses, and can they grow the growthier businesses? And that's what they've been doing. So I don't know. I don't give it much credence to be short this name, not at this multiple, not at this valuation.
Let's go on to another stock that has, been in and out of favor, let's say, over the past few years, and that is American Express. Obviously, their business is a reopening stock, tied to travel, business travel, maybe most especially.
Yeah, so leisure spend, we know, has recovered. We're back above 2019 levels. We've heard it from Hilton and Expedia, and we've heard it from all kinds of other companies that leisure demand is back, right? But it's business spending, it's T&E spending that's in the early innings. And I don't think it's appreciated that this is going to recover into next year. I was very encouraged last week by the bank's credit card billings as a whole, averaged up 25.2%. That's very encouraging. So people are spending. They have a huge range, though, in terms of guidance and in terms of earnings, 750 to 870. So I hope they're going to narrow that. I think they will. They're going to stay conservative because this is a heavy, heavy investment spend year. You're going to get the operating leverage next year, especially as business travel returns.
And finally, one that is in the energy area, and my favorite company name to pronounce, Schlumberger. I just love it.
It's a hard setup, Tyler. It's up 55% on the year. It's up 131% in the past year, but it only trades about 25 times earnings. This is the leader, number one in the industry. And I do want to hear about the demand and the recovery, but most importantly, CapEx budgets have been coming down substantially for the entire sector. We know the majors are cutting CapEx by about 17 to 20% this year. Does that continue and it leads to a tightness in the market, which is what we're seeing now? I also like their international business and their digital strategy. The question is, can they do EBITDA of $4.8 billion this year to $6 billion by 2023? I think they can, and I'm looking forward to the call.
Stephanie, do you think this is, in general, going to be the kind of earnings season that tells people this has to be a stock picker's market, the better, competitors versus the weaker links, that kind of thing? Or is it more about rotation and kind of the big macro variables like bond yields and how the CPI does and that kind of thing?
This has been such a rotation year. The first part of the year was value into growth. Then we got a growth scare with Delta. So mid part of the year, we had growth into we had into value from growth in the first quarter. And then you had into growth in the second and third quarters. Now you are seeing a rotation again. And I think it's because the economy is on the mend and people feel better. Rates are going higher. That usually favors value over growth. But to your question, I still do think it is a stock picker's market. You're going to have the haves and the have-nots. And look for companies that have pricing power. That's going to be the most important thing so that they can offset these inflationary pressures.